What happened this time is the shutdown of the government. So it got stuck at $1 trillion. This is where we got it wrong because it wasn't something we could know. And there's one bit we missed that we didn't really fully grok at the time. And that was the fact that once the reverse repo had been drained, which was a net stimulus, net liquidity boost, the rebuild of the Treasury General account, they build this bank account up and down. So it doesn't really matter. But when you've got no offset to it, and the Fed is doing QT, that was a 700 billion tightening in financial conditions since July. It was dramatic. Once they drain it, it starts lifting asset prices significantly, the normal cycle. Okay, that's the game. That's the whole game. Understand that, and you understand everything that comes after it.
Today, as the crypto market continues to crash, with Bitcoin falling below $86,000, billionaires like Elon Musk sound the alarm amid Bitcoin price crash fears that we could witness something much worse in the weeks to come. But Raoul Pal issues a warning to all Bitcoin and crypto holders, and the sell-off we're seeing is only the beginning. The Bitcoin tsunami that's coming will change crypto forever, and Pal discusses the inevitable collapse of the fiat money system as we know it, and says there's a plan to take over Bitcoin and crypto. With BlackRock being one of the biggest players to get into the space, this will be the least of our concerns, as entire countries are now coming for Bitcoin. With the current price sitting just under $86,000, still down over 14% in the past month. In this latest interview, Pal discusses why it's more important than ever that nation-states adopt Bitcoin and incorporate into the global economy before the inevitable collapse of the current monetary system as we know it. Everyone's focused on tariffs, inflation, and the so-called weak dollar. But Raoul Pal is seeing something completely different, and it might be the most underreported economic shift of 2025. Behind the scenes, the US just pulled off what could be the biggest corporate tax cut in modern history without even changing the official rate. Through new depreciation rules, companies can now write off almost everything. That drops the effective corporate tax rate to somewhere around 10 to 12%. That means the US just became the lowest taxed major economy on Earth. Let's get right into the latest interview with Raoul Pal, as he gives us his prediction for Bitcoin in the coming months, and why a massive surge in capital is about to pour into the crypto space. Drop your comments down below and subscribe if you enjoy the content we do here.
So here we are, the shutdown's ended. It takes a while before the money starts flowing. So the TGA's only just kind of released $40 billion, but we're expecting like $200 billion or $250 billion over the next 2 months. So what happens then is eerily similar, should stabilize coming few days, next week, today, who the hell knows, doesn't really matter. I know it feels like it does, but it doesn't. And then the market took off like a rocket ship. And all of this is to say that the reason we look at all of this stuff is Bitcoin is, and crypto is, a macro asset class. That's the important thing to understand. What it means by macro, it's driven by macroeconomics. And macroeconomics, for me, is the business cycle. And here is the business cycle, up and down. We talked about that before. And lo and behold, remember that, the 4-year cycle? Well, that was the crypto cycle. And right now, the ISM is kind of in that middle year where it's not hooked up, not grown. Bitcoin's slope has been frustrating for people. I want this bit. Well, it's going to come in the next 12 months and everyone's going to go, he said that last year. He's just a snake oil salesman. Look, market analysis is not some sort of crystal ball where you see the absolute truth in everything. The everything code is the truth. How it plays out is still something we need to learn. And we need to understand the nuances. When the world gives you lemons like a government shutdown, you need to deal with it. You bought the ticket, you take the ride, and you just kind of grow up and deal with changing probabilities, because that's how the world works. When we look at financial conditions, this is our financial conditions index, which is correlated to gold, as I said, even though it's not, gold's not in the index. Total liquidity lags it. So by 3 months. So it's suggesting that liquidity should start rising, which makes sense because we know what we've got to do. We've got to pay the debt, and we know that the TGA is going to be drained, and the QT is going to finish, and the Chinese are increasing their balance sheet. and we got regulatory changes coming, and we got rate cuts coming, blah, 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 blah. And the ISM, the business cycle, follows that. So the next thing for the business cycle is to go higher. Business cycle going higher means we'll have money in our pockets. It goes into risk assets, and that increases the price of crypto. Why does Raoul have this everything code thesis? What has he built? I try and explain to people, and I've done videos on this. This is how the world works. It's simply the structure of which the entire system functions and why it functions that way. The inflation of the 70s was not a monetary phenomena. It was actually driven by demographics. It was driven by the baby boom cohort coming into the workforce all at the same time, demanding goods. And there wasn't enough supply for those goods, so the world had to adapt. Then we had obviously the Suez crisis and a bunch of other things that came onto it, and a bunch of money printing and other stuff that happened, but and then leaving of the gold standard, all of this stuff. But really it's a demographics issue. As they've aged out, they've also driven everything from investment markets, index funds, pension market, everything has been driven by this cohort. So this cohort is now retiring. It's leaving the labor force. As it leaves the labor force, we can project out into the future because of the births, deaths. What happens to the labor force participation rate? This is happening everywhere. It's falling over time. So as it falls over time, and forecastably so, we increase the debt to goose growth, because growth is driven by population growth, productivity growth, and debt growth. Debt growth is this part that I'm showing you, is to offset the slowing of the population growth and that decrease in the labor force participation rate. Less people being productive in the labor force, old people are less productive, and that leads to slower growth. So the government increases debt to offset it. That debt is financed by liquidity. This measure here is the Fed net liquidity, but actually in recent years, it's moved to US total liquidity and global liquidity for the global debt cycle. What's the difference between Fed net liquidity, global liquidity? Fed net liquidity is the Federal Reserve balance sheet plus the Treasury General account and the reverse repo that's now been drained and probably will never get rebuilt. But they've moved the liquidity onto the banks now, which is what our total liquidity measure takes into account, that plus M2 growth as well. Anyway, it doesn't really matter. Liquidity is the baseline of money to pay the debt, driven by the demographics. Okay, that's the game. That's the whole game. Understand that, and you understand everything that comes after it. Then we've created this cyclicality. We had a perfect 4-year ISM cycle that changed, and it's driven, the cyclicality of the economy is driven by the debt maturity distribution. So the debts have to be rolled, and we need to, because going back to this chart, if you remember, we pay it by debasing currency. And so when the debts get rolled, currency debasement increases. And that is the process by which markets and economies have operated since. It's all the same cycle, and it happens globally. So up until 2024, we had this perfect 4-year cycle. I mean, perfect.
Raoul says it's the fastest pace of adoption of any investable asset in all of human history. By the end of 2025, there will be 1.1 billion active crypto wallets. The pace of growth is hard to comprehend, and it will be the fastest accumulation of wealth we have ever seen. This is the conclusion of a career's worth of research. And every single chart and piece of research leads to the same conclusion. Liquidity drives everything, and crypto will be the best performing asset of them all. Raoul has been stressing to investors for months that all the factors are beginning to align right now, a period characterized by parabolic moves upwards in crypto prices.
And then something changed, and we're like, what is going on here? We didn't really understand it until we went back to this and redid the maths and realized in 2022 and 21, when rates went back to zero, they extended the maturity of the debt from 4 years to 5 years, or 5 and a bit years. And so what that did was break this. We had this extra year in the middle that we never had before. The extra year in the middle didn't need peak refinancing. The refinancing is for this coming 12 months. So we haven't had peak refinancing. So you didn't get peak economic growth. Economic growth was held because we didn't get that stimulus. Rates remained higher because of it, and the cycle extended to this. And this is the 5.4-year sine wave. Now, we don't know what the next cycle is going to be, depending where all the debt maturity ends up. They're all sticking it in the short end right now. It might shorten it back down to 4 years. Don't know. We'll have to see, but this is what we're dealing with. And where we should end up is peak cycle is somewhere towards the end of 2026. This is the reason we don't believe in the 4-year Bitcoin cycle that's suddenly independent of the NASDAQ. They're all the same cycle. Or the ISM, it's all the same cycle. But suddenly some people online are like, well, it's all over now. We didn't get our rally in November and October. It's finished, all over. Let's come back again in 18 months' time. So the game is paying the interest payments of the debt. That is where the debt growth is coming from, is the interest payments. Don't forget, the interest payments are now a larger part of the US budget deficit than the military is. And we do that by printing money. Dun, 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 dun. I mean, I've told you this a million times. So we print money and look, we've got lots of debt to roll and we need to print money to do it. Okay. And hey presto, gold has been following this like it knows. Yeah, because gold is real-time financial conditions right now. Financial conditions, the dollar, interest rates, and commodity prices. And gold is reflecting financial conditions, which is the forward look on liquidity. I'll come on to that in a sec. A bit confusing for you all, but gold is kind of explicable right now. Here's GMI global total liquidity versus gold. Gold says it should accelerate. Global total liquidity has been it got to new highs. It's flatlined a little bit because of what the US is doing. Meanwhile, China's increasing the use of its balance sheet, and the dollar's gone up a little bit. I think it probably rolls over at some point soon. We'll come on to that in a sec. And that then may lead to the final leg higher in gold and the final leg higher in markets. But you can see gold is basically pricing global liquidity impulse all the way to the end of 2026, which would be kind of what we're expecting for the cycle. Again, don't expect perfection. Raoul said, everything moves, deviates. You need to assess the probabilities, see the data as it comes in and understand. But when I put gold versus I don't know why Julian's put everything in pink. I don't know. He's feeling flamboyant. But what we've got is that's interest payments. Gold is forward pricing it. And following up is liquidity, which lags gold by 12 months. So we've actually got the phasing of all of this, these dominoes. We talk about these dominoes all the time. And why it matters to us is because it explains 90% of crypto's moves over time. Now, again, this is the issue with the impatience and the people who don't understand this stuff is like, well, liquidity's moved. Why hasn't Bitcoin moved? It's all broken, everything. It's like, no, it doesn't work like that. There is a variability around this stuff. This is a weekly plot chart going back 11 years. Not 11 years. It actually goes back, 12 years now. And you get variability around the mean. That's how markets work. That's the 10% difference in correlation. So you expect differences, and the differences give you informational value. But what you get is this stunningly high correlation over time. And again, people don't really understand this. They're like, your charts are just correlation versus causation. You're just inventing stuff. I'm like, no, and no. That was what caused that global M2 chart that like people just don't understand, because I said it's not going to work all the time. But why didn't it start? Why did it break apart? Well, it broke apart very simply because liquidity got sucked out of the system, and it got sucked out of the most beta to liquidity asset in the world is crypto. So it came out of crypto. And if you think of the crypto beta curve, you got Bitcoin and then Solana, let's say, and then let's say SUI. They're all different levels of beta or leverage to this trade. And what happened is liquidity starts coming out over this period. Now, the TGA should have been started draining two months ago. And once they drain it, it starts lifting asset prices significantly, the normal cycle.
Pal stresses this pattern is normal and necessary to flush out weak hands and reset leverage. He highlights Bitcoin's high correlation to global liquidity, which remains supportive, even during temporary liquidity air pockets. He believes the market is setting up for another strong leg higher. Similarly, Bitwise CIO Matt Haugen supports this view, pointing to a dip-then-rip pattern, where sharp pullbacks are typically followed by massive rallies, up to 190% gains historically. Both argue that patience, not panic, is key. The banana zone is alive, just misunderstood. As the momentum in the crypto market is building and institutions are positioning themselves, Raoul Pal says everything is about to change. He says the next phase of the crypto cycle is critical, and he's stacking big bets in his portfolio right now. With the next bull market, and with crypto and technology being the biggest investments this year, Raoul Pal says that he's remaining bullish on digital assets after significantly increasing his position size during the last bear market. The former Goldman Sachs executive gives a portfolio update on which crypto assets have the biggest upside in the coming months. He says we're about to see massive capital pouring into the crypto space. With major pension funds and institutional investors on board for the coming cycle, Raoul Pal predicts that crypto is on track to be a $10 trillion digital asset class. Pal says that this cycle will separate itself from its predecessors, as devalued fiat currencies will push more adoption into the crypto market and bring in more capital than we've ever seen before. Bitcoin is one that is headed for an unprecedented price milestone, and Raoul foresees a financial tidal wave that will catapult cryptocurrency to new highs. Raoul Pal says the crypto world is on the brink of something massive, a seismic shift for Bitcoin and crypto in what he calls the banana zone. As the momentum is building and the institutions are quietly positioning themselves, Raoul says everything is about to change. He recently shared his take on the current economic uncertainty, with tariffs and recession fears creating market volatility, that a major market rally is on the horizon. And that's where Bitcoin comes in. Bitcoin has been trading more like a risk asset lately, meaning if the market recovers, Bitcoin is expected to surge alongside it. But the uncertainty is key here. If the market remains stuck in limbo, Bitcoin could face short-term pressure. So we could see a sharp recovery in the next week. The bottom line, Bitcoin's next big move depends on how this plays out.